Hi, and welcome to the Day Trading for Beginners podcast. This is episode 26. And in this episode, we are talking technical indicators and oscillators. So what I thought we would do is talk a little bit about, what technical indicators are, what oscillators are, and then we are going to review three sort of popular indicators. Now, there are many, many more, and that we will get to eventually on this podcast. Here, we're going to talk about three of them. We're going to talk about moving averages, the RSI, and the MACD. Now, I would sort of recommend that you also consider subscribing to the YouTube channel, because we're going to talk about these. It's going to be very much an introduction to these, but it's certainly clear that you will want to see some visuals when you are learning technical analysis. So for this podcast, I'm trying to sort of document everything I'm doing, and I want to share what I'm doing in the podcast when I'm learning technical analysis. But it's pretty obvious that you will want to sort of jump in and use some charts. You'll want to see a visual, and you might need to sort of read this stuff on your own. So, listening to this podcast is great. If you get a few nuggets from today's episodes, that is ideal. But certainly don't expect to have a full understanding of what the MACD is after just going through this podcast. It took me quite a while to understand it. I needed to read some text. I needed to watch some videos, and so on. So again, I want to document what I'm doing. At the same time, this section, this technical analysis section, it's a little bit hard to totally teach and for you to totally learn through just an audio podcast. So certainly just keep that in mind. Now, in the next episode, what we sort of have on the schedule is I want to talk about volume next week and then talk about chart patterns. But certainly there are other indicators that we're just not going to get into today that I also want to cover. And I think that a video format for those is going to be better. So certainly in the show notes, you can find a link to the YouTube channel. You can subscribe. I'm going to be documenting the journey there and having more sort of lessons and visuals on this stuff over in that section. And again, our community on School, everything is posted there in a course format, a podcast, and the video. So you can certainly go and find links to that through the website. And everything that I'm doing, you can find in the 6-month blueprint. You can find that in the show notes. You can go to stokestrades.com/blueprint. You can download that. So again, thanks for listening. Just a few housekeeping mentions regarding sort of learning technical analysis and sort of what we're going to talk about in this podcast and some recommendations moving forward. Okay, so let's get into it. Technical indicators and oscillators, and then three examples. So, analysis paralysis is a real challenge, I think, when it comes to learning how to day trade, certainly from, what to do, how to start. And that's really what this podcast is supposed to help us with. But when we start encountering the technical and indicators and oscillators, there's quite a few of them. And, you might be bogged down by trying to analyze charts and using every single one of them. So I remember reading from some successful traders, there's certainly no holy grail indicator. Many traders sort of recommend keeping their charts simple. So, we're going to talk about indicators. You might use some of them. You might not use, you might use some of them. You might not use any of these that we're going to talk about today. Certainly these ones are popular, but again, you don't need to use them all. And later on, when you figure out what your strategy is, you might be using some over the other, but you'll certainly want to just understand, what each one is, and then later decide if, you will find it useful for your own trading strategy. So again, here we're just going to talk about moving averages, the RSI and the MACD. They seem to be popular indicators. So, in terms of what is a technical indicator? Well, technical indicators, these are tools that we are going to use to help analyze past and current price information on the stocks that we're tracking. Certainly you can do this with currencies and other financial instruments as well, but we're talking stocks here. So basically these are tools to help us analyze past and current price information to help us, make predictions on future price movement. So if we sort of backtrack about what we've been talking about here in terms of technical analysis, so, day trading, swing trading, short-term trading, we need to use technical analysis as opposed to fundamental analysis where you're looking at, the financial stability of a company, its management, its forecasts into the future. All that stuff is for fundamental analysis and for more long-term trading, where, you might want to own a stock for the next, 3 to 5 years. So that fundamental analysis will help you figure out if a stock is currently undervalued or overvalued based on your analysis. But for us, we don't really care about that stuff because we are trading stocks, in one day or in a few days if you do a little bit of swing trading. So we need to look at the price action. We need to see what the price is doing at this moment. And then we need to make trading decisions based on where we think that price is going to go. And that is what technical indicators can help us do. These are tools that we can use on a price chart. So, when we're looking and we're doing short-term trading, we're looking at, the price chart. It's the candlestick chart that we spoke about in some previous episodes. We're watching the price action of the stock as it's moving throughout the day, sort of minute by minute, or you can look at, an hour candle stick. You can look at a longer time frame as well, but we're watching the price action. And we're going to make trading decisions based on what is happening. And what we do is we use these indicators to help us make decisions. So essentially, these indicators, a technical indicator, it takes the raw data from the market prices and volumes and then transforms them into something that's more digestible and usable for us to kind of figure out. So when we talk about the three in today's episode, it's going to sound complicated, but what's great is that is just sort of pasted on a chart for us to visually see. So we can't sort of interpret all this data ourselves just based on looking at a line chart or a candlestick chart of a stock, but we use these tools to help give us visuals and help sort of compress and formulate data points to help us make decisions on where we think the stock is going to go. So in terms of technical indicators and oscillators, general indicators, an oscillator is a subset of an indicator. So so all oscillators are indicators, but not all indicators are oscillators. So if that sort of makes sense, a technical indicator can be an oscillator, but not every indicator is an oscillator. So hopefully that's clear. So that's what a technical indicator is. So what is an oscillator? Well, what does that even mean? We might want to just review what oscillation means. So oscillation, in simple terms, it's sort of like a fancy way of just saying back and forth movement or fluctuation. So in physics, you might be able to relate to this a little bit more. Oscillation, it's the movement back and forth in a regular sort of rhythm. So if you think of that, pendulum swinging back and forth side to side, that is sort of an example. It's this movement, it's governed by forces that restore the object to a midpoint or equilibrium position. So it's oscillating back and forth. So in technical analysis, oscillators are tools that help us understand when a stock's price might be getting ready to change direction. So they measure how strong the price movement is and whether the price is moving quickly or slowly within a defined range. So you can think of it sort of like a speedometer in your car that shows how fast you're driving. Similarly, these oscillators in the stock market, they don't measure speed, but they measure momentum, which reflects the rate at which the stock prices are changing. So momentum, think momentum when we're thinking oscillators. And by indicating how rapidly prices are moving, oscillators can signal whether a price trend is likely to continue or reverse. And that is going to help us decide when to buy and sell. So that's the tool. So an oscillator, it's an indicator, and it's a tool to help us sort of gauge the momentum of the stock. And then we can make our trading decisions from there. And, what's great is that, these oscillators and these formulas, they are all done, and you sort of just click a button on your trading platform, on your charting software, and you can kind of visually see these on a chart. So in terms of how oscillators work, you can think of like a range and something with like a high and a low signal. So most of the time, these oscillators have like a scale that runs from 0 to 100. So you'll look at your chart on the screen, and then below you'll have another little chart that might go from 0 as a low up to 100 as a high, and there might be a line graph there. And then when that graph, that line chart is, reaching low or reaching high, that will, indicate something to you and help you make trading decisions. So, they give signals when things are extreme. So if the value is something very, very high, that might mean that the stock is too high and it could start going down. And then if the value within an oscillator is very low or close to, the extreme low level, that might mean that the stock price is low and it could start going up. So that's sort of like how these oscillators work in terms of, technical analysis. So they help us traders determine basically the optimal times to maybe buy or sell based on the momentum of the market. So like using a thermometer to sort of gauge like the temperature before you maybe go outside, traders can use these oscillators to kind of like feel the pulse of the market dynamics. And again, this guidance helps in making informed decisions, predicting, when a trend is likely to continue or reverse and so on. So that's just like some background information of what an oscillator is. So in terms of why we use these tools, these indicators and oscillators in our short-term analysis, firstly, trend confirmation. So indicators, they're going to confirm if a market trend is likely to maybe continue or reverse, and that's going to help you make buying or selling decisions. Signal trading opportunities. So maybe there's some patterns in these indicators that are going to suggest to us that there might be an optimal moment to enter or exit a trade. And then in terms of reducing risk, you're getting objective data on some market condition. And these tools can help you sort of maybe avoid emotional decision making and focus more on some evidence based strategy. So, in terms of like a good overall sort of definition or, talking about how these fit into technical analysis, right? Like we mentioned, technical analysis itself, we're studying price action. We're studying how the price of the stock is moving, primarily through the use of charts. So we're looking at a candlestick chart. So for the purpose, what we're doing this for is we want to forecast future price trends. So these technical indicators and oscillators are very, very important for doing this. What they do, like we mentioned, is they provide like a graphical representation and math calculations of market dynamics that are not readily apparent just by looking at the price chart. So we're going to talk about like a moving average. You can't just look at the price chart and see what the average has been over the last 10 or 20 days or 200 days, but you can use an indicator that'll show you exactly what it is on the chart. So that's just how these indicators and oscillators sort of fit into our analysis. And by using these indicators, what we can do as traders is we can see patterns and signals that are going to help us understand market movements in a way that just raw data alone cannot. So, we're using these tools to gather the raw data into things that can help us, can help show things, signal to us what to do, or help us predict what's going to happen with the price moving forward. So that's sort of like what these technical indicators are and how they fit with technical analysis. So the first one we want to talk about is what's called a moving average. And this one is very popular. I think most people are going to use this to some degree in their trading strategy. Again, it's very popular. And what it's used for, a moving average, it's used to smooth out price data over a specific period. And it makes it easier to identify the trend direction. So basically, by calculating the average price of a stock over a set number of days, moving averages, what they do is they offer a clear view of whether a stock's price is trending up or down without the distractions of, the daily price fluctuation. So daily price fluctuations, there's a lot of noise. It's going up and down for various reasons. But when you average all that out, you can see a nice smooth line, and it's just going to help you identify if the stock is in an uptrend and a downtrend and so on. So basically, exactly how they work, it's very, very simple. This is a simple indicator. And basically, it's calculated by just averaging the stock's closing prices over a specific period. Some averages don't use closing prices. I think for the most part, closing prices is what is used. So if you want to just think of a 20-day simple moving average, what that does is it just sums up the closing prices of the last 20 days and then divides by 20. And you're going to get a dot on your chart. And then when you move to the next day, well, you just, drop the previous 20th data point, and then you just take the next one. So this process, it's repeated daily, adding the new day's closing price while dropping the oldest, and it smooths out the short-term volatility and it reveals this underlying price trend. So moving averages, you can use a 20-day, you can use a 10-day, and then you can use a 50-day or even a 200-day moving average in your trading strategy. So again, why are these used? Well, trend identification is probably the most common reason why. These averages, they're going to help you pinpoint the overall trend. So if you think about it, if a stock price remains above a certain moving average, like the 50-day, it's generally considered in an uptrend. So if the current stock right now is above what its average over the last 50 days has been, then it's in an uptrend. It's better than what it's been doing in the last 50 days. And then on the flip side, if it's currently below what the average has been over the last 50 days, well, you could, reasonably consider that it is in a down trend. So that is, the main reason for using these moving averages. Also, they're going to help maybe identify some support and resistance levels within a stock that we talked about. And then when we talk about strategy, which we're not going to talk too much strategy yet, but in the future, when you look at strategy, you might want to look at where these averages are crossing over. So, traders often watch for a short-term moving average. So maybe like what the average has been over the last 10 days, crossing over maybe the 20-day moving average. And what that would do is it's going to signal that there's an increase in momentum and potentially a new trade position. So if, what's been happening on average over the last 10 days is now rising and it's crossed over and it's higher than what has happened over the previous 20 days on average, then that could be a signal that we are in an uptrend. So that's a sort of strategy that you might take on later when you actually start trading. So those are simple moving averages. You will come across other terms called exponential moving averages or weighted moving averages. So the simple moving average, it's simple. That's what its name is about. Sometimes you just have to really, when you see these terms, just, some of them sound confusing. That one doesn't, but, sometimes the name is really what it describes. So it's a simple moving average because it just gives an equal weight to all the data points. Whereas, so for example, you've got a 10-day moving average. You're going to add up the last 10 days and just divide by 10. So it's equal. Whereas these exponential moving averages, so an EMA and then a weighted moving average, a WMA, these assign more importance to the recent prices. So basically, what's happened recently is going to be weighted differently in the average. So we're not going to get into how the math works, but just know that, these ones, the EMA, so the exponential moving average and the weighted moving average sort of were designed to overcome the shortcomings of a simple moving average by putting more emphasis on recent data, which can be helpful for you as a trader and maybe your strategy. So again, moving averages, to sum it up, they help you see the average of a security over a certain period, making it easier to spot trends. And this is a popular indicator that you can just put on your chart very easily. And it's probably one that you are going to use. And in the future, you will probably want to study more strategy that is involved with, using these to help you make your buying and selling decisions. So before we get to the next one, RSI, it's worth just noting this idea of lagging and leading indicators. So if we think of moving average, which we just spoke about, that is referred to as a lagging indicator because it calculates an average of past prices. So it smooths out past data, sort of clarifying the trend after it has begun, but it doesn't sort of predict new trends. So it's a lagging indicator. It relies on historical data, meaning that it's great for confirming ongoing trends, which, based on historical data, it's true, but it's less effective at sort of spotting the start or the end of the trend. So it's more of a lagging indicator. It helps confirm a trend, but in terms of forecasting, it's not that good. But then you've got these things called leading indicators. And the next one we're going to talk about is the RSI, the relative strength increase. And a leading indicator, its aim is to predict future price movements by identifying sort of early signs of something that might be overbought or oversold. So these indicators can offer early warnings about potential market reversals. But keep in mind, it's not a perfect situation, or else everyone would be making money in the market. So they are susceptible to sort of false signals, and you need to use them with other tools. But that is the difference between a lagging indicator, which is a moving average based on historical data, and then a leading indicator, which is supposed to forecast or predict some price movements. And the RSI is one of those. So let's get into that now. This is another popular one. And again, we're going to do a discussion here, but certainly you will want to go out later and review this for your own learning. And certainly in the future, we might have a video all about this where we look at this on a chart and we talk more detail about it. But here we're going to just get an intro into what this is. So what this is it's an oscillator, and it measures the speed and change of price movements of a stock. So it operates in a scale. So that makes it an oscillator. We've got a scale from 0 to 100, and it helps identify whether a stock is considered to be overbought or oversold, and it sort of predicts potential price reversals. So what it is calculated by, what you do is you compare, the formula compares the average gains and then the average losses over a period of time. And it's typically 14 days. So the formula, and we won't get into what it is, but basically you're comparing that the average gains versus the average losses over a period. And from that, you will be able to potentially forecast the momentum of a stock and what it might be doing. So, in terms of, how it works, again, there's a calculation. You start by calculating the average price increase, and then you take the average price decrease, and there's a ratio there. So that's referred to as like a relative strength. So the strength of the gains over the losses, and then you put it into a formula, and then this formula helps create sort of like an index and creates a range. So you can see this ratio in a nice range from 0 to 100. So when you're interpreting this range, you are going to be able to try and predict, or the range is supposed to provide conditions that are potentially overbought or oversold. So when this value of the RSI, this relative strength index, when the value exceeds 70, so it's a scale from 0 to 100, and when it exceeds 70, what it suggests is that the stock might be overbought. So this condition implies that recent gains are disproportionately high compared to any losses during the same period. So again, the formula kind of calculates that out. And then if you get a high level in this index, it's saying that the gains of the stock are disproportionately high to the losses. And what this essentially means or suggests is that the stock has experienced strong upward momentum without significant pullbacks, making it potentially overvalued or primed for a price correction. So that is sort of how that works. And then traders can use that information to make trading decisions. So again, the RSI, what this index does based on a formula, compares the magnitude of recent gains and losses. If the average gain over the RSI's calculation period, so 14 days, it's larger than the losses, then the RSI will increase. And again, for a value that's considered above 70 in this range, it's showing that the gains have been gaining significantly. often due to heightened buying activity. So there's a lot of buying activity, which might not be sustainable. And then this could lead investors to anticipate a pullback as some traders might start taking profits, expecting that the rapid price increases are likely to slow down or reverse. So this high RSI value signals an upward price momentum as possibly overextended, making a critical indicator for traders looking to predict reversal. So if you go out and you look at the chart and you apply this RSI value, you can see that in certain situations, it's clearly obvious that when this RSI value is high, the stock does tend to trend down afterwards. So it doesn't work every time, but it's clear enough that in situations in the past, the RSI value has been correct in making that assumption. And then on the flip side, you got an oversold condition. So when this value in this index goes below 30, it typically indicates that the stock may be oversold. And this condition suggests that recent losses are disproportionately high compared to any gains during that period, potentially signaling that the stock is undervalued or due for a price rebound. So an RSI below 30, it signifies that the stock has been experiencing significant selling pressure, often leading to a downward price push that might be excessive relative to its true value. So when you look at a chart, you can sort of see this as the RSI value hits around 30. If you look up at a chart, there are situations where the stock trends upwards afterwards. And then when you've got an RSI value in the 70, indicating things might be overbought, sometimes it certainly does trend downwards after that level. So, why would you use this? Well, if you just kind of think about what I just said, traders can identify potential entry and exit points based on, this perceived overbought or oversold condition. And then there's also this thing called divergence. So we'll talk a little bit about this here, but I think we'll kind of wrap it up after this discussion because, we can go into it even more detail. But for this intro, I think we'll stop there. But in terms of using it, you can see entry and exit points. And then there's this thing called divergence. So it detects whether the price movement differs from the RSI trend, indicating a potential reversal. So divergence, basically, when things diverge, so a bearish divergence, basically it's a situation where the stock price will hit a new all-time high, but the RSI fails to reach a new high as well. So that suggests maybe weakening momentum and a possible price decline. So this interpretation, basically it suggests that while the prices are reaching higher highs, the momentum behind those prices is maybe weakening. So the RSI, again, we talked about it, it measures the magnitude and velocity of directional price movements. It's confirming the new highs. Confirms that with new highs and highs of its own. So this lack of confirmation in a bearish divergence basically maybe can be a warning sign that the upward price movement might not be suitable or might not be sustained, possibly leading to a decline. So again, the overbought and oversold are quite not simple, but the basics of it. And then there's also this idea that, the price is going up, but the RSI isn't. So there's a divergence there. And, that is sort of a more advanced topic to get into, but I thought we would just mention a little bit of it there. So again, just to sum up the RSI, you can think of this index like a thermometer of the stock market. So it's going to measure the speed and change of price movements, helping you identify if a security is overbought or oversold. So hopefully that was somewhat clear. Again, if you're listening to this, don't worry if, you haven't totally grasped that by just listening to one audio snippet of it. Certainly come in the show notes. You can have a link to the article. We're going to have a video about this too. And it's something that you will want to review on your own a few times, but hopefully something there gave you some nugget of information or something clicked and that was useful. So the last one we're going to do here before we wrap up this episode is the MACD. So this one is even, if we want to talk about complications, this one is a little bit more complicated. So we've gone from moving average, which is relatively easy to understand, and then the RSI, which offers a bit of a mathematical formula there. But again, it's an oscillator with a range. So somewhat easy to understand that when it's high, it's considered overbought. And when it's low, it's considered oversold. So again, it's easier to understand. This one might take you a while to sort of get it. Personally, I needed to review information on the MACD quite a bit to sort of understand. But, let's talk about it, just an intro. And again, don't be worried if you don't quite get this. So this indicator, it's called the MACD. And what that stands for is Moving Average Convergence Divergence. So we'll talk about convergence and divergence as well to be able to kind of explain that. But basically, it's the MACD. That's what it's known as. And it's a tool used by traders basically to understand, again, market trends. So at its core, the MACD is about comparing two moving averages of the stock. One moving average that covers a shorter period, and then one that covers a longer period. So you're going to compare the average of a short period and a longer period of the same stock. And when you compare this, it helps you as a trader spot changes in the direction and strength of stock prices over time. So by observing how these two averages converge, so come together, or diverge, so move apart, the MACD provides a clear signal that can guide traders on when to buy and sell. So when the moving averages are converging or when they are diverging, that can give you a signal on when to buy or sell a stock. So that's the convergence and divergence. So moving average, convergence, divergence, MACD. So it's like having, a personal assistant that helps you kind of decide when to get in or out of the market, making it easier to manage your trade. So again, no technical indicator is perfect, but this one is quite popular and it can be quite useful as well. So let's talk about sort of how it works. It's a little bit complicated, but we'll get into how it works and hopefully hopefully this is useful for you. So basically, this indicator, it has three components. You've got the MACD line itself. Then you have this thing called a signal line, and then you have a histogram. So we're going to talk about these three things. So the first thing is just the MACD line itself. It's sort of like the foundation of this indicator, and it's calculated by subtracting the 26-day exponential moving average of the stock's price from its 12-day moving average, exponential moving average. So you've got the 12-day moving average. So you've got a 12-day moving average. So the average of the stock, what it's done over the 12 days, the average. And then you take away what it's done over the 26 days. And then you're going to get a value. And that's going to be the value on your line. So that number can either be positive or it can be negative. So that's what it is. It's you're subtracting what the average has been over the 12 days, take away what the average has been over the 26 days. And that's the first line that you get in this indicator. So then you have the signal line. And what this is, it's the 9-day exponential moving average of that MACD line, acting as a trigger for buy and sell signals. So the signal line is an average of an average. It's the 9-day average of the MACD line, which was calculated by taking the 12-day moving average of the stock minus the 26-day moving average of the stock. Okay. So you got the MACD line and you've got a signal line. So you got two lines. And obviously when one is above the other or when they cross, that is going to be a signal for you as a day trader. And this is plotted underneath a stock chart and it's plotted on a histogram. So a histogram is basically, you've got a zero line and you've got bar charts above and below the line of zero. And the histogram is meant to simplify this relationship between that MACD line and the signal line. So it's a visual tool on your stock chart and it shows the difference between the MACD line and the signal line through bars. So if you're wondering, whether the MACD line is above its averaged signal line, well, bars on this histogram will show you if they're large, if they're small, if they're below zero or above zero. The bars are going to help, you give you a visual of a trend and what might happen next. So that is basically what the components are of the MACD indicator. Like always, you'll probably want a visual of this, and in the show notes, you can find a link to this as well. So, okay, so why these numbers 12 and 26? Where do they kind of come from? Well, these specific numbers are standard in the industry, and they were originally chosen based on the traditional sort of working days in a month, roughly, corresponding to 2 weeks and 1 month of trading data. So the 12-day average is what's called faster or more responsive. So if you see something and it refers to as a line is faster or a line is slower, that's basically refers to how it responds to new price changes. So the average, it's faster because it considers fewer days. So a change is going to influence it more than a longer or slower average. So it's more sensitive to recent price movements. And then you've got the 26-day moving average, or it's really an exponential moving average. It's slower, smoothing out volatility and providing sort of a longer term line. So, what does this show? Well, the difference between these two averages gives an immediate visual representation of the trend's momentum. So if the MACD line is above 0, it suggests that the short-term momentum is higher than the long-term momentum. Because remember, the formula is you take the 12-day average and then you minus the 26-day. So if that's a positive number, if that's above 0, it suggests that the short-term momentum is higher than the long-term momentum. And then you can see that visually on the chart because the line graph has a 0 in the center. So it'll go down below 0 when it's negative and above 0 when it is positive. So when it's above 0, it's more of a bullish condition. The short-term averages are rising higher than what the average has been sort of in the 26-day period. So that means, things are rising in the short term. It's rising. So it's bullish. And then again, if the MACD line is below 0, it suggests more bearish conditions. So that's the MACD line. And again, 26 and 12 are the averages, and you take this, you subtract them there. So then the signal line, this is essentially a smoother, or again, slower version of the MACD line itself, because it is a 9-day average of the MACD line. So it's an average of an average. So it smooths out the fluctuations more extensively. So why have the signal line? Like, what is the role? Why have the second line on this chart? Well, it acts as a trigger for trading signals. So when the MACD line crosses above this signal line, it's typically seen as a bullish signal. So it's a good time to buy. And then when it crosses below, it's seen as a bearish signal, maybe a good time to sell. So if you kind of just think about that, when the MACD line rises above or crosses and then goes above the signal line, that means that now the MACD line, the momentum is greater and rising faster than the average of what it's been for that 9-day period, because that's what the signal line is. It's an average of the MACD line. So when the MACD line is above that, that's signaling, a bullish momentum. It's a signaling that it is going higher. So that's really what that indicates. And the slower sort of nature of the signal line, because it's an average of an average, it makes it useful as a trigger for trading signal. So again, when the faster MACD line crosses the lower signal line, so it crosses it to the downward area, that's a potential change in momentum and trend strength, which traders might see useful for buying or selling decisions. Again, so the signal line is there. And then when you see that the MACD line crosses this line moving up or below it, it's just going to tell traders or potentially give information that now is maybe a good time to buy or sell. So that's sort of what it does in a nice visual way. And it takes all these averages and these data points and puts it into a visual representation. That's really what we kind of said these technical indicators are. That's what their role is. And then finally, that histogram. So the histogram, again, it's a graphical now representation. So it's bar chart. It's a bar chart. It's a bar graph. And it represents the difference between the MACD line and this signal line. So, what does it show? Well, it provides now a clear visual. So you can look at this bar graph, this histogram on your chart, and it provides a visual of how far apart the MACD and the signal lines are, indicating the strength of a trend. So again, it takes all these calculations that are made up within the MACD line and the signal line. It's the difference between the moving averages, and then you've got the 9-day average of that line. And now it's visually represented on a nice bar graph that you can visually see something, and you can just spot these trends easier in this visual form. So, positive bars. So when the bars are above zero, suggests that the MACD line is above the signal line. So that's bullish. And then when the bars are negative on the chart, so they're below the zero center line, it indicates that the MACD line is below the signal line, and that could be seen as bear. So, increasing the bar length signals, what that does is when the bars are bigger or smaller, it shows the momentum again. So it's just a good visual representation of all this data. And again, by listening to this, obviously you might want to check out these charts of visual representation, and then you should have a sort of better understanding of them. So I think a good summary to wrap this up is to just briefly again let's go over what happens when the lines cross. And if you can sort of understand this, then this sort of wraps up or kind of brings everything together sort of for this indicator. So again, the MACD line, the dynamics of the MACD line. So that line, again, it represents the difference between two exponential moving averages of the stock. So you've got the 12-day average and then the 26-day average. So the 12-day average and you minus the 26-day average, and then you've got that line. When the MACD line now crosses above the signal line, as we've said, that indicates that the 12-day average has moved above the 26-day average. So this shows that recent price changes, so within the 12-day period, are rising faster than they were over the longer 26-day period. And what this suggests is an increase in the short-term momentum relative to the long-term momentum. So being able to see that with these lines is what this indicator allows you to do. And then the signal line, it's an average of this MACD line. It's a 9-day exponential moving average. It represents a smoother version of these movements. It moves slower because it accumulates this data over a shorter period of time, but in a more sort of averaged way. And then when you interpret the crossover, that is a trading signal. So when the MACD line again crosses above the signal line, it suggests that recent price momentum is strengthening and moving faster than the average of the past, which is reflected in that signal line. So this, typically is interpreted as, a bullish signal indicating that the prices, might continue to rise and could be a good time to consider buying. So that's again, we kind of reviewed that. We repeated ourselves a bit, but that's basically what this indicator is showing. So this crossover point, it points to a shift where the short-term prices are gaining strength and outpacing more moderated view of the recent price trends, which can kind of indicate a potential upward movement in the market. Okay, that's sort of like a summary. And again, why does this work? Well, this tool, this MACD, Moving Average Convergence Divergence, it's a helpful tool for us traders because it puts together a couple of important trading concepts into just one easy to read indicator. And I know we're talking on audio here, but when you visually see this, when you understand all these components, it's easy to read. So essentially, again, it measures both the direction of the direction that the stock price could be heading in and how fast it's moving in that direction. And it does this by comparing the two averages over different periods one shorter and one overall a little longer. And then the difference between these averages forms this line, which shows if the stock's momentum is increasing or decreasing. And then again, this MACD, the whole indicator, uses the signal line, which is a smoothed out version of the line, and this histogram, which shows the distance between the MACD line and the signal line. Again, all these features, they just help you see when the stock might be ready for a buy or a sell by showing entry and exit signals more clearly than you would get by just not having the tool and just looking at a simple price chart. So again, these are tools to gather data and show you them represented on the chart and to help you with, your buy or your sell signal. And again, this combination of features, it makes this indicator, it makes the MACD very valuable for traders to be able to catch and follow trends in these fast moving markets. So I hope that you found that useful. That's the MACD. We're going to talk about this in even greater detail in probably video format to sort of look at all of these, visually see them. And then even in the future, when we start talking strategy, we're going to talk a little bit more about what is a buy signal, when is a sell signal, and talk about some specific situations as well. And we'll get into that, when we have a better grasp of technical analysis in general. So I hope that you found this useful, sort of an intro to these indicators. At the very least, now you can hopefully have in your mind, what the role of these indicators are. And then, listening to some of these examples, you can kind of see how these indicators work and how valuable they can be and how we need to use them as technical analysts doing day trading. So thanks so much for listening. Subscribe to the podcast. Again, in the next show, I think we're going to talk volume, then we're going to talk some chart patterns. And then within the next few weeks, I hope to get more videos on YouTube that describe these technical indicators and many of the other ones as well. So there's quite a few other ones to cover as well. But again, we're on this journey, we're progressing, and soon in a couple of months, we're going to wrap up the first 6 months. And I think we've come a long way, and we'll do a whole recap of everything that we've studied. And again, this podcast, in the show notes, you can find the website, you can find our community on School, where all this stuff is going to be put into these free courses that you can just simply follow along and do everything that we've been doing over this journey. So thanks so much for listening, and I will talk to you in the next podcast.